Day trade.
Well, I was worried because I got stuck in an elevator. I don't know about y'all, but
Really?
got stuck on the 3rd floor, so it took me a few minutes to figure out how to get out of it. But I did.
Climb out the top?
I'm sorry?
You climb out the top?
Yeah. No, not that brave. But I'm supposed to use the microphone, I think, so I'm not sure. Okay, I think I will. I will probably hold it. Before I start, let me ask just a real quick question. How many of you were at the luncheon? If you raise your hands. All right, I'm going to hit those slides. I'll go right past them, all right? I'll mention it, go past them, but that way we'll have a little bit more time maybe at the end for a little Q&A. But I'm going to go ahead and get started because I got a lot to cover. How many of you saw the market today? Okay, so rye, how many of you are rice farmers? Let's start with the rice, okay. Soybeans? Okay, corn? Wheat? Cotton? What are you doing in here?
Crawfish market's down today.
Yeah, crawfish, yeah, I don't know about crawfish. Okay, good, well, that gives me a little bit of an idea. Now, the grain markets were up and the rice market was down today, and I'll talk a little about that in a little bit. All right, let's see if I can, all right, go through this. Hopefully, I know the camera's supposed to be there, but they know I'm a walker too, so hopefully. A year ago, when I was here, this is where the market was. We were trading 1172 in the March 2016 futures. When it went off the board, it went off the board at 1049. November, when I was here a year ago, was at 1234. It went off the board at 985. A lot changed from the time we were here last year until the end of the market. Here's where we are today. We're 976 in the March 2017 contract. That is down $1.96. And we also saw an increase of 606,000 acres of long grain rice last year. That was the thing we were not expecting. November 2017 has not had one trade in it. Not a one. So we don't know where it's at. We're expecting somewhere between 400,000 and 500,000. We'll talk about that in a minute. Last year when I was here, the carryover projected was 22.7. Today it's projected at 29.7. So we're up about 7 million, and that's with the yields not being so good last year. I kind of like this picture because it just gives you a little bit of an idea of what you can do for an alternative use of your farm equipment. If you don't know anything about me, I'm an Aggie, hold MBA from A&M, 1,500 acre farm in South Texas. I was on the floor from 89 to 2011. I'd go up about 6 or 7 times a year, something like that. Pilot, I think they went over all that at the luncheon. Here's my current positions. I always like to show people what that is, just in case they're, because at some point in time I'll probably talk my position here, but you can see we're pretty well sold the 2016 crop. 2017 we're not interested in selling, although we have made the recommendation in the beans to sell any and all soybeans that is an increase in acres in 2017. We made that recommendation quite a while ago when we started to see that there was a lot of people that were growing more soybeans. Risk adverse, I'm a hedger, not a speculator. I'm a technician and a fundamentalist. I like to develop a long-term psychology or philosophy about the market. I don't think it changes. People do the same thing they've always done. Floor trader approach. There's different floor trader approaches. There's not just one, but my floor trader approach is what I learned on the market. It's not where the market's at that counts. It is how it got there that matters. And that's especially when you're looking at future price conditions. Market analysis, and we're going to go through this, economic fundamentals and technicals real quick. We're not going to do much on the technicals at all today, but we want to walk through these other two quite a bit. Economic cycle. Again, I always like to show this. In a capital society, we have the same cycle that happens all the time. We start with expansion and growth. There's a crisis, there's a recession, then there's a government response, and then there's a recovery. And right now we are in an expansion growth cycle at this particular point in time. What's next is a crisis. Was that going to happen? No idea. And we're going to look at employment, GDP real quick, and interest rate picture, and see how things have changed over the last year. Because something just doesn't seem quite right. And it takes you a second. That's a bomb they're trying to get the pin out of with a hammer and a knife. But what you can't probably tell is that guy's eyes are closed. Just in case. Employment conditions, let's start with that. The little, they're gray or blue lines, as you can see right here as they go up, that represents recessions. Last recession, of course, the 2008 banking crisis. You can see unemployment moved up. Here's where the unemployment's at right now, 4.9%. One of the economic laws is that whenever there is a recession, there is a spike in unemployment. So it's one of the reasons why we like to watch unemployment very, very closely. In previous years, we've said there's not been a setup for there to be a spike in unemployment, but that is not the case right now. There is a setup for that at this particular point in time. Weekly claims continue to fall. They're the lowest level since back in 1974. That's good. Part-time economic reasons, that continues to be a high number because, again, many people will work 2 jobs because of the fact that a full-time job does not provide them the benefits. And so they will do 2 part-time jobs in that regards, and benefits, company costs for benefits is a major concern for them right now. Here's new home sales, which is always a big factor. Notice after the big crash, this is the big housing boom and bust. And we've just now come back to levels which are about average since back in 1963. There's still a distressing gap between used homes and new homes. Most of that is because there's not that much volume for new homes at this particular point in time. Most economists would say that that has taken a long time to change, but it does show a continued negative part of our economy. When we look at the recession cycle, it's kind of interesting. If you look at the difference between recessions by years, you can see that we have had quite a few recessions. If you average those up, the distance between those is 6 years. That is the average time. If you take out the high and low and average together, it's 6 years. Where are we at now? We're at 8. So again, we're approaching a period of time which would say, we may have something coming on the horizon. Is there anything out there that would trigger that? You betcha. There's several things out there that would trigger that, but I don't know what will. All I know is that this poor guy's got a problem. Because the horse is just saying, you just think we're going somewhere. And that's really what's happening. A lot of people just think we're going somewhere, and there's a lot of concern about what is getting ready to happen. I'm going to be completely apolitical in this, okay? I'm not going to have a political agenda. I just know that there's enough things going on out there that we have to be watching a lot of things at this particular point in time with our economy. So we're still seeing job growth that's continuing. It's expected to flatten out here in 2017. History says higher employment is likely over the next 2 years, so that's something to watch for. Let's take a quick look at our GDP and the outlook there. As far as investment goes, okay, let me back up a bit. I was at a conference recently, and somebody came up to me, I won't say who it was, and they came up to me and said, you're not addressing the big imbalance of our exports and imports. We've got this huge deficit, in our trade balance. And you have to understand how GDP is calculated because it doesn't matter what imports are. And let me show you why. GDP is defined as investment plus consumption plus government spending plus exports minus imports. That's what GDP is. So here's what you need to know to make sure that you understand this. All of the imports will go to investment, consumption, or government spending. It's a zeroing effect, net sum zero effect. So that is why imports really don't matter that much because they're there, but they end up going through the cycle and they will show up in investment, consumption. So those are kind of a zeroing effect. So it's not that big of a deal that we have this huge imbalance. So higher imports does not hurt the GDP, has no effect on it. Here is the GDP that we have right now. This is through the third quarter. The fourth quarter, they're just coming out with numbers which are down around the 1.8, 1.9 number. But you can see the U.S. is doing pretty good. We've got a good GDP that's going right now. When we look at the GDP forecast through 2020, you can see we're up to about a 22 trillion economy. And so we're still trying to stay ahead of that debt. And we're struggling to do it, but we've got a growth cycle that's going on with that. I wanted to show you China because this was a big thing we showed last year, maybe a year before, as China's growth continues to be substantial, although the growth is starting to, or it has slowed down in this time frame right here in 16 and 17. It's not quite as much as what it was, but you can see that the forecast is for their rate of growth to pick back up again. And if that starts to happen, if you were at lunch, I talked to you about the BRIC countries, and that means that we could start to see a little bit more of a demand cycle start to come out of China. We're not sure that's going to happen. I'm not an expert on China. Don't want to come across that way at all. So we'll have to wait and see what exactly happens with that. But this growth cycle here for China is certainly interesting. The USDA now says that the United States in the year 2030 will still be the largest economy in the world. And everybody looks at this and you see China here at 22, but look who's third. India, 6.6. There's a huge increase for India. India's a country that's not on your radar screen. You should put it on your radar screen and watch it, because there's a lot of growth occurring in India. It's huge, okay? So we're seeing the China GDP scaled way back, because the last forecast we had a year ago had them actually in the lead by 2030. So our GDP shows continued expansion, no sign of slowing, but it's going to be interest rate dependent. So now let's talk about interest rates. When we look at the interest rate picture, this is the chart that I showed for literally 4 or 5 years as we had this thing called ZIRP. Remember what ZIRP is? Can you tell me what ZIRP is? Okay. I keep thinking someone's going to finally have this figured out. It's called zero interest rate policy. If you have a zero interest rate policy, that's what the government has had. It's called ZIRP. And this is the big thing with the Fed, raising the rates, okay? Well, the Fed started to raise the rates, and they've now raised it twice. You can see here's now the current Fed rate that we have in our for our markets right now. So we're up to the 0.5, 0.75, and we're going to ZIRP no more. It's over with. How many increases do you think there'll be in 2017? Anybody want to take a shot at it? Three? Anybody else? Do I hear 4? Yeah. So there is a way that you can tell what the market thinks, because there is a way through options and through different technical trading that they actually can make wagers, if you want to call it that, or trade different interest rates. So in case you're interested, here's their current situation right now. There is a 70% chance of 2 rate increases in 2017, according to the market. There is a 37% chance that there will be 3 increases in 2017, according to the market. So we definitely are seeing an uptick in interest rates, right? Now, during this period of time, when you look at the 15-year jumbo, you can see that we had this spike back in the first part of January, but it's actually come back down since then and kind of leveled out at this 3.95 level. Here's the 30-year mortgage rate for the jumbo. You see we had that big spike, and then we dropped back down and we're 4.49. So there's not a whole lot of change from where we were back the first part of January. The Fed and inflation. Just remember, the Federal Reserve is not a government agency. They are mandated by Congress. They're under the control of Congress, but they're not a government entity as such. But Congress has mandated price stability and maximum employment to be their responsibility. And what they consider to be those 2 things, the FOMC has stated the PCE, that is what you and I pay for everything, should go up about 2% a year. And our unemployment rate should be between 5 and 6%. They believe that is full employment, anything between 5 and 6%. Current situation, we're at 1.7 PCE. This time last year, we were 1.22. And our unemployment rate is 4.9, so we're under that 5%, which we were last year. And that is inflationary. Anything over 2.5 in the PCE is going to be considered inflationary as well. Here's that current chart. You can see that the core PCI, or of course CPI I should say, is above the 2% level, and the core PCE has come up over the past 13 to 15 months. So we're seeing an increase in those levels as well. And so there's some minor pressure that's occurring. This is the M1 money supply. M1 money supply. Remember, inflation is too much money chasing too few goods. And so what we've seen is this massive amount of infusion of cash, and it came about through quantitative easing. So we had 1.4 trillion in the system as we came out of the 2008 recession, and now we've come up to this level where we are at 3.42 trillion in that M1 level. Remember that money supply turns over. As it turns over, that's called velocity. As velocity increases, then all of a sudden you can have too much money chasing too few goods. And so that's the concern, is now we've got this huge amount of money in the system, and what happens if it starts to speed up in velocity. So that's what the economists are watching. So the PCE suggests that there's some minor inflationary risk the next 12 months. Unemployment suggests there's some minor inflation risk. And the M1 money supply shows a growing inflationary risk as well. Deflation is not at all likely. Remember, inflation is actually something that we as producers know could have an impact in our grain markets as well. ZIRP is not going to return unless all of the wheels come off, and that's certainly possible. I got to go back on that one. For any of you guys that are University of Texas, I apologize. I just couldn't resist it. I came across and I said, I got to put this in my presentation. So I'm an Aggie, right? Anyway, okay. So here's our economic situation. We see some more upward pressure on interest rates over the next year. I think everybody agrees with that, and the speed of those increases are going to be very important as we move forward. Inflation is definitely on the Fed's radar. It is a growing risk. The good news is they have a lot of tools to fight inflation and no tools to fight deflation. Now, the ag economic cycle is also the same as the capital economic cycle. It works exactly the same way. You have expansion, crisis, recession, government response, and recovery. The difference between the ag economic situation and the current situation in our own economy is that we are already in recession. And some people would say that we are in depression. And it just depends on how bad things are, obviously. But the recession type situation, there's a lot of market fear. You know, I travel and speak all across the country, and I guarantee you, you're not alone. It is everywhere I go. So we've got a lot of market fear with the producers really recognizing that there is some recession occurring in this agricultural cycle. What's next? Probably some type of government response. However, we're not at the best of conditions or positions in the government response area because we just had a transition change. In other words, we've just gone through a new administration. I'm on the ATAC committee, and I can tell you that we've been told, get ready. We're going to start hearing some things, but the fact of the matter is, at this particular point in time, we don't know anything. I can't tell you a thing. I haven't had one phone call at all in that regard. So we'll have to wait and see what kind of government response we get, but it's going to be a while, and then we can look for a recovery. 4 major areas of discussion I want to go through. One is energy costs, Chinese demand, oversupply of grains, value of the dollar. Then we'll talk a little bit about the government program and 2 areas of concerns with the reference prices and the payment limitations. All right, let's talk first of all about energy outlook, or what I like to say, will OPEC cuts hold? Will they really do it? Now, for you guys that were at lunch, you probably have a good idea where I'm getting ready to go with this. But I showed this slide. I'll go through it really quickly. If you weren't at lunch, what we show here is this is the OPEC net oil export revenues, $920 billion at the top of this 2011 timeframe, and that has now dropped to $241 billion. So what they have seen is this massive loss in income, and because of that, OPEC has decided that they need to try to cut production. And when you look at this one, this is really an interesting one. It was so small, I didn't talk about it much at lunch. But Saudi Arabia in 2014, their net production or net inflow from oil exports was $247 billion. And so far from January to May, which is the last numbers I've got, they're only at 39. They've had this massive loss in income. When you look at what it takes for them to break even, they need $104 a barrel to break even. Now somebody's going to say, oh, they can produce it cheaper than that. They can. They can produce it cheaper than that. But again, remember what we're talking about here is what their budget is. If you're a citizen of Saudi Arabia, you get a check every month. You know, you get a check. That's why there's so many sheiks over there, I guess. And all of a sudden, there's not much checks coming. And that's because of the fact that we've got the price of oil sitting down here. So they're not able to do their budget. They're not able to match their budget numbers. Here's the current oil chart. And notice that this is back here around 2014. It was when it started to decline. Right in here is where Saudi Arabia came out and said they're not going to stop production. They're going to continue. And here we saw the decline under $40 a barrel. Right now we're back up to this level, just over $50 a barrel. I showed you this at lunch. This is the amount of oil that we're producing since 2008 out of these tight oil shale plays. And you can see we're still holding around 4 million barrels a day, and that number has now gone back up. So my next chart will show an actual increase. When I get the next one of these, it will show an increase in the amount of oil that's coming out. Here is the weekly oil production. I showed you this at lunch. This is October of 2007. Notice we're sitting about 8.5 million barrels a day. And this is where we are today as we approach 9 million barrels a day. So we have already picked up 500,000 barrels of new oil production with the price of oil at 53 bucks. So again, I'm going to go on the record and say, in my lifetime, we will never see $100 a barrel oil again. Now, my lifetime is probably not that in the distance. You know, you can say that. So I'll say it another way. My son will never see $100 barrel oil in his lifetime. We are awash all of a sudden in oil. We're washing it. And so what else happened is with the new technology, just go to the OTC conference sometime. It is absolutely mind-boggling what we're doing in production capability. We have a tremendous amount of capacity. And so notice the U.S. has responded at $50 a barrel and added, and we still see every week the drilling rigs going out. And one drilling rig today was like 10 drilling rigs 10 years ago in what they're capable of doing. So weekly crude oils at these levels, we think this is going to be the new norm. We're going to be looking at probably under $60. Now there's going to be some spikes, there's going to be some issues. Venezuela is a big concern, so we expect to see some spikes in that. We could see some issues there. But we expect for the most part, we're going to see this be the norm here for crude oil in the future. Here's natural gas. Didn't even talk about that at lunch, but look at the amount of natural gas that we're able to do. It is just, again, mind-boggling in the amount that we have. And so we're looking at natural gas staying here at this level. You see that price? It's $3.20. That's for nearby nat gas. You want to know an interesting statistic? I can go buy July natural gas for 2020, 3.5 years from now, for 40 cents less than that. 40 cents less. So I just tell you what the market thinks of the natural gas supply and the natural gas going forward. So 4 major areas of discussion. There's energy costs. Let's talk about Chinese demand. I should have blown this up. I'm sorry. I should have been higher, bigger than this. What you're looking at is the soybean commitment. This is soybean commitments year over year. And this is our current year that we're in right here, the red. And these numbers are the 2013, 2014, and 2015. And you can see the numbers that we have down here. So look how much more commitments we have on the books right now in soybeans than we did this time in the last 3 years. The yellow line up here is the USDA projection of how much we'll have for the entire year. Now what I want you to understand is we're at week 21. That means we've got 31 more weeks. And in that distance between those two numbers is only about 3.2 million metric tons. So what I'm saying is the amount of selling to China in soybeans is going to completely dry up. It's going to move to South America. It's going to happen quick. It's coming fast. The other thing that we have to be concerned about is any kind of a trade situation, because right now we have over 5 million metric tons that has been sold and it's on the books that has not been shipped. And if China comes in and decides to do some type of trade penalty to us, that is what's on the books that they could cancel. And if that type of thing happened, then the market, yesterday's big move down in the beans will be nothing compared to what would happen if that kind of thing took place. So just follow this Chinese commitment situation really close. We don't know what's going to happen there. I'm not trying to make any projections or predictions. That's not what this is about. I just want you to have it on your radar screen that there is some risk here, at least going forward. And the big push-up that we've seen in prices over the past 3 months in beans is pretty much gone. There's not going to be any big purchases of soybeans by China coming up. Here's just the weekly sales, and you can kind of see how all the big sales were back here, and they're starting to move together year over year right here at week 20. So that's the Chinese demand issue. Let's take a look now. We're going to talk about oversupplies later. So let's take a look at the US dollar. Here's the value of the dollar back in 2014. You can see it was trading around 82%. What this is it's $82, but it's 82% of the value of a basket of currencies against the US dollar back in 1998. So that's how that number comes up to be. So sometimes people call it 82 bucks, sometimes people call it 82%. It's totally up to you, but you can see what happens to the dollar is it rallies up in 14, and notice that it moves higher. Now what has taken place here in 14, remember that super cycle we talked about, is that the dollar is going up because those other economies are showing weakness. And so people are running to the US dollar, and that's why we saw that big run up right here. We got up to the 102 level. This is where it closed today. It was down pretty hard today, in fact. And so we're seeing the possibilities of a little bit of a top, and the market may correct, which of course is good for exports. Just know that we've had a 20% increase from the 82 level to the 102 level, and that's the same thing as a cost of 80 cents more for corn for our buyers just because of the dollar. It has nothing to do with supply and demand. It's just the impact of the currency in corn based off of what is happening with our dollar. So there's the value of the dollar. Government concerns, just a couple of really quick things for us guys in the rice market especially. The two things that we're going to really be looking at is number one, coming into the 2018 Farm Bill is going to be the reference price. Obviously we need that number to be $14 or higher. Most people believe that $14 is not break even, but the government never tried to give us a break even price. The idea of the reference was to be a shallow loss. It was not to be profitable. It was to be a shallow loss. And so that is why that number comes in here at $14. And I know that there's going to be some people that are going to be arguing the number needs to go higher because of inflationary costs since the Farm Bill came into play. Good luck on that one, but we'll see how it plays out. As far as the other big concern, it's going to be payment limitations. We need to make sure that that payment limitation stays around the $125, especially when you have a $4.20 government payment expected to come your way. So those are two of the big concerns as far as the government for 2018, and we're already working on that at this particular point in time. I'm going to be in Washington, D.C. all next week, and we'll get our first really good look at what, and we won't get a really good look because we know there's not Undersecretary of Agriculture haven't been appointed and those kind of things, but we'll get a first look at what the conditions look like with the USTR and the USDA, especially after all the work done on TPP and then it failed. So if we can just keep the government out of our business, that's a wrecker up there pulling a cop car. He thought it was dry for some reason. Anyway, grain fundamentals, let's look at it. Trend supply, trend of demand, government activity, market psychology, that's the perceptions of the market. When we talk about world numbers, we're going to use, again, trends. That's what we're looking for. This is the 2007 year. Watch the ending stocks of the world numbers of rice. And that's where we are right now. So we continue to see this increase in the supply. Now, some of this is China, and for some reason, my Sands China chart didn't get in this deck, and I apologize for that. But we're about 49 million metric tons without China. China's numbers are kind of squirrely. I mean, so we kind of just keep that out of here usually. But those are what the USDA says. So when you look at your WASDA report, that is what it's going to show, 118.3 million metric tons. And usage is up to 473 from 428. So rice usage continues to go up, but it is still down from 2013 levels. Cash prices. On January 1st, U.S. was selling rice at $4.70. Thailand was at $3.55. Vietnam at $3.37. India $3.55. Pakistan at $3.55. The U.S. was higher by about $115 a ton. To be really competitive in the past, we've needed to be in that $60 to $70 range. But we're 115 over right now. Thanks, Ryan. Appreciate that. What is it today? Watch those prices. From 470 down to 440. Thailand dropped to 345. They dropped 20. Vietnam's at 343. India's still at 350. Pakistan went up to 400. So the U.S. is higher by 105 right now to the Thailand price at this particular point in time. You're wondering why you're having trouble getting a bid for rice? There you go. World market price. I think the traders are finally figuring out that this really doesn't mean anything. It means something to us in the government program, but I think that the funds have finally figured out it doesn't matter. They've been trying to push the futures market to the world market price for a long time. It's not working. But that's where we are right now, world market price at $8.50, and you can see it's from September to this price range, it hasn't changed a whole lot. I look at the trend here more again than the actual price. Export prices, if we look at all of them here, you can see the United States from 2006, right now $450 versus $379 Vietnam. Now this is from the USDA. This is not the current price, this is the current USDA numbers, and they're not looking at current prices. But I wanted you to look at the 337 and go back up. When was the last time Vietnam was that low? Yep, you gotta go all the way back to 2006. Thailand, 379. Yep, 2006. US, 450. Yep, 2006. So we have a real depression in the situation of export prices at the present time. When we look at the difference between US and Thailand, this is kind of an interesting slide, because in 2006 we were about $87 higher, 2007 $70 and higher, but watch what happens. In 2008 we're $1 higher, we're $26 cheaper in 2009, 2010 it's only $6. What's going on in those years? That's that intervention. That's that $40 a hundredweight that you get to sell your rice for if you're in Vietnam and Thailand. 2011, we're $32 cheaper. But then things started to change. 12, we're 50 higher. 2013, on average, we were 160 higher. 14, 83, and right now, in 15, 136, and now right now we're at $82 higher. Trying to get down to that $60 range where we might get a little bit of business. However, they're not the cheapest price anymore. It's India, and that's who we're starting to fight against now. Ending stocks. Watch the Indian number. Back in 2007, 13 million metric tons. 2014, they're 17.8. Now we're at 17.9 in their ending stocks. They're definitely down from the 2012, but they still have a large amount of ending stocks, and that is with a 10 million metric ton export number. So they are they're a big factor to deal with. And you'll notice the United States ending stocks in metric tons is the highest, going back to 2007. Strictly long grain. Export volumes, I showed this slide at lunch. I'll just go through it probably just really quickly. Again, notice that India takes the lead at 10.4 in 2011. Look at their average. They've been about 2 to 3. They had that 1 year where they had some higher exports, but now they're in the 10. They do that for 4 years, dropped to 8.5. Now they're back up to 10. India's doing the very same thing in rice that Saudi Arabia was doing in crude oil. They do not want to lose market share. And because they don't want to lose market share, they are going to continue to sell. And they are selling at below cost, they are selling at low prices, and they are not going to give up market share. Once that camel gets into the tent, it's in the tent. And so until something changes in that regard, we have to deal with that side of the equator. Here's the supply and demand. This is again in million hundredweights, beginning stocks coming into 2016. Notice the production number, that declined in the last WASA report, down to 166. Total supply, domestic use, they cut domestic use by 1 million metric tons, they cut exports by 1 million metric tons, total usage is 180, and there was the ending stocks 29.7. This is from the last WASA report. This number right here, exports at 78. Look at the domestic use, 102. That's what they had to do in order to keep this number down. And we're going to see what happens when we talk to them. We got a meeting with these guys next week, so we're interested to talk to them about this. So remember, 1 ton equals 22.46 hundredweights. Exports, when I was here last year, running about 1.4 million metric tons. Right now, we're 1.2. That means we're 117 behind, and we're supposed to be up 1.5. And compared to USDA estimates of 141, that's 141,000 metric tons. And so if this rate holds, the carryover will go back up from 29.7 back up to 33. And that's what we're saying. We expect it to be between 31 and 35 at the end of the year. So ending stocks for rice long grain, here's the current number, 29.7. Go back up. 2010, we had a bigger number. But again, we're expecting this number to probably go up to about 33 before it's over. If you're wondering about your PLC, this is an interesting chart. This is the current farm price and the current farm calculation. So if you want to look and see what we're doing as far as current prices, the current average today, $9.90 off of $14. Obviously, that would be a $4.10 PLC. For shortcut, the best thing you can do on that is to take your historic yield total historic yield, not your per acre, but total historic yield, multiply it times 77%. It'll give you kind of a shortcut to find out what your PLC payment would be, and then multiply it times $4.10. Here's what I want you to notice. If you remember that last slide, production for 2015 was 133 million hundredweights. Production for this year is 166. We're up 33 million hundredweights. Yet the amount of sales to date, 9 million hundredweights versus last year at 10, when we had 33 million hundredweights less to market. That'll tell you there's a lot of rice that hadn't been moved. So there's a lot of rice that still has to be calculated into this number before it's done. The USDA right now is figuring that number to be, average would be $9.80, so it's $4.20. That's the USDA projected average at this particular point in time. Planted acres for 2016. Arkansas went up 380,000. Louisiana up 85,000. Mississippi up 50,000. Missouri up 40,000. Texas up 49,000. Obviously, Texas got their water back, and that was the large portion of that number. Total up 604,000 in those 5 states. California went up 2,000 acres in their long grain. So the bottom line is we had a 606,000 acre increase from 2015 to 2016. What are we going to do in 2017? I don't know, but I can tell you we did it to ourselves. If you'll notice real closely, that guy actually cut a little hole there for his nose, but that's paper and he's welding. I don't get it. Anyway, we got to be real careful what we're doing. Planted acres, 2017. Right now what we're hearing, and this is all over the place, so I'm just giving you the averages. Arkansas back down 225, Louisiana down 36, Mississippi down 49, Missouri down 37, Texas down 23. That's 365,000 acres. Sorry about that. Hold on a second. Must be 3 o'clock. Yep. There the market is.
Show us that market, that'll wake us up.
Yeah, put you to sleep, wouldn't it? Make you sick anyway. Okay, so that's where we are right now. We still have 241,000 more acres than what we had in 2015. Okay, the numbers on corn, I just wanted to show you this real quickly so you can kind of see what our competition is. Notice in 2012 we dropped 821 million bushels as far as ending stocks. We're now back up to 2.355 billion. And you can see there's nothing even close on that. And that's why the corn market's having a hard time getting over its reference price. Soybeans, when we look at ending stocks, it dropped down in 2013 to 92 million bushels. But you can see what's happened since then. We're up to 420 in the last USDA report. And I frankly think that number will probably be just a little bit higher than that before it's all said and done. Wheat numbers, this one is really a killer. In 2013, we dropped to 590 million bushels. But since then, it has just been all the wrong direction. And that's our current carryover, 1.1 billion bushels in wheat. So we've got a lot of oversupply in the United States in all of the markets. And the only market that is above reference price is soybeans. Everything else is below reference. So key crop fundamental issues, massive world grain supplies. In fact, in 2012, we had 453 million metric tons in a carryover situation. Today we've got 621 million metric tons. That's about 6.05 billion bushels of grain. All different grades, of course. 2017 U.S. acreage outlook is going to be key. Right now we're hearing about 4 million acres lower in corn, up 5 million acres in soybeans. I read a report yesterday that says they're now saying one of the big analyst firms came out with 6.5 million acre increase in soybeans. That's huge, and they lowered the corn to 3.5. But these are the numbers we've heard. Rice we're expecting lower, down about 400,000, not sure yet. Cotton, we're not hearing much change there. Wheat's already down 4.5 million acres. So overall ag fundamentals are negative. We've got large corn stocks. We've got a big, much larger world supply of soybeans coming. Wheat acres, or wheat, large supplies there. The dollar is going to hurt exports, but if we could see that dollar continue to break, that might help us a little bit there. Rice, big acres coming, we don't know. That's going to be the big issue. Remember, in February, the USDA will have their Outlook conference. We'll get our first look at what their numbers look like as we move into that meeting. Exports, higher dollar, of course, is obviously affecting our demand right now. And the outside market factors, oil, right now, this is what we've been talking about, is that the oil is going to be at a higher level near term, but we're bearish to the oil market over the next several months. All right, so the fundamentals, large supplies, technical indicators. Not going to spend much time here. The main thing I want to focus in on technical indicator, if you're not using this in your marketing, just know that all a technical indicator does is it says that in the past, when this has happened in the market, then it has done this in the market. That's all a technical indicator is. It's looking for something, a pattern that says, we've seen this before, and it usually does this afterwards. It'll help you get over the hump if you use one in your marketing. There's chart patterns, market indicators, seasonal tendencies, and market participants. I'm not going to spend hardly any time here. In the rice market, here you see the futures market. This is where we're at right now. This is the our day. That means that it's a continuous chart. This is where we did to. This was where I pulled this up. I think the market was actually lower than that during the session today. Here is one of the technical indicators. This is these are called Bollinger Bands. You can put them on almost any chart that you can get that's free, whether you use barchart.com or whatever you're using for charting purposes. You can add those to it. But the Bollinger Bands, what it does is it says that 99% of the trades will occur between those bands. And whenever they trade outside the bands, then that means something. And you can see when they do, the market has a tendency to move away from it. Again, when this has happened in the past, this has happened, so here it happens, so this happens. Again, that's just the technical side of it. It's kind of the thing I love to do. I always tell people when I was walking around on the floor in Chicago, I never saw one time any of those guys holding a supply and demand table. Ever. They're holding charts. And they had their own systems, everything imaginable. But they're technical in nature, so that's the way that is. One of the advices that we're giving our clients right now is we would not be very, very aggressive in selling rice. And one of the reasons is because that we think we are going into a cycle where we're going to have lower acres. And that should mean, if that's the case, that we may start to see the seasonality functions work. Notice that the seasonality is for a dip into February. This is over the last 20 years. And then there's a tendency for the market to go up during the March, April, May timeframe. And when we think acres are going to cut and we think that there's going to be some end users who are a little bit nervous about that, we're telling our clients there's no reason to be very aggressive sellers at this particular point in time. If you can hang on to it, we would hang on and see what happens here. We don't think the risk is enough to be panicking and selling at this particular point in time. It's also been our message to the banks that we've been meeting with, because they've been saying, we need our guys to sell. And I'm like, no, you don't. And then when they see this, they're like, oh, I see why you're saying not to sell. So have this, if you're going to see your banker and he's putting pressure on you or something, maybe you can cut this out of the video. But if that's the case, then grab this chart and say, hey, at least DeLaughter that says I shouldn't be selling, and go from there. So there we go. Those are the technical indicators. So there's the market analysis. We've done the economics. We've done the technical indicators. Soybeans, we think they're going to sell off. We've been bearish on that. That's why we sold the new crop. But we're not selling new crop aggressively for people when they're normal, only what they're going over with. And that's another story, but that's our position on that. And then corn, wheat, and rice, we think they're against major lows, so the risk to the downside is not that great in return. Obviously, when I do this, somebody will say, Dennis, I don't understand a thing you said, so what do you think the prices are going to be? So here's our outlook right now. For corn, we're looking at a range for December 2017. It's trading around 375, and we're saying 485 high if we start to see some kind of a risk in the market. One of the things that I can tell you is a lot of guys up in the Midwest are not using as much fertilizer as they normally do. And so there may be a little bit of a tendency for production not to be as high as what it would normally be. So we may get a little bit of upward pressure. But if things are absolutely perfect, we start to approach 175 bushels an acre, then yeah, we could see the market down close to a $2 handle. In the soybeans, trading around 10.11. In the Nove, 10.50. We're seeing that as the low if the bushels per acre is down. But we see the very real possibility of back under $9. And the beans are starting to approach their reference price, which is, I think, $8.85. Don't quote me on that. think that's right, but I'm not sure. Wheat, 441, actually it's lower than that now, but we're seeing 495 if we start to see a problem with the wheat as it comes out of dormancy, 390. And again, that's still under reference. Reference is 550, so we're not seeing this market at all, even to the reference price there. 390 on the low side if we start to see a huge wheat crop come out. As far as rice is concerned, we think lower production will allow us to return to a $4 premium. This is a Texas presentation, so let me try to put this over into normal conditions. That would be around, on the Chicago Board of Trade, that would be about a 1050 futures price. So that would be the number that you would look at from a futures. We think the premium is a lot likely for 2017. Now again, remember, the PLC that we're getting right now is based on the 2016 crop. The crop that you already harvested. The 2017 crop doesn't even start to get calculated until August, okay? So you have to remember that. So when we start talking about what we think PLC will be for next year, 275 to 375 is the range in the PLC calculation that begins in August of 2017. Current price offered in March of 2018. Do you know that that's there? It's not even trading in November, but yet there is a way to get to the March contract if you want to do some due diligence. And that current price in the futures is $10.84. That's $10.84. If you want to know how, you can come up and talk to me afterwards and I'll explain. Cotton may allow for prices to go higher. There's definitely some issues in China about cotton. We don't even know the whole story there, but we're definitely hearing that there could be some issues. Cattle, we still see, even though the cattle report wasn't that bearish that we got out last week, as far as the long term, we still see a long-term build, and we expect some pressure on cattle. My final thoughts are this: be patient, sell rice later in the year, as I showed you why. Look to sell grains heavily on a weather rally if La Nina is active. One of the big things that, in fact, in my presentation notes, I said I'm going to go through La Nina and explain it. There's no reason to do that because La Nina is not happening. This is the current situation of La Nina, and notice this: anything below the black line is representing a La Nina condition. Anything above it is El Nino, and now the forecast is by April or May that we will be back into an El Nino bias. So La Nina is not even a factor. So I'm not going to even explain that. I'll do that next year when it's a factor if it is. As far as, again, final thoughts, sell on scale up. Once you get to profitable levels, guys, don't let that get away from you. This is not the year for greed. This is the year for survival. So if you start to see where you can break even on prices and they're being offered to you, make sure you start scale up selling and get something done, and then set out a plan and stick to it. I like this because, number one, most of you probably heard my tractor story. I'm not going to do it, but I got 5 tractors stuck in the same field one time. And this is a perfect example of doing the same thing over and over again and expecting a different result. If you're doing your marketing program the same way over and over and over again, then just don't expect a different result because it won't happen. So this is a whole new world. And I'm going to just basically close with this idea. I had a guy come to me and he said, "Dennis, we've been here before, we'll get through it." And I just want to tell you, we've never been here before. We've never been here before. We've never seen countries not want to lose market share to the point that they'll pour billions of dollars into production and then compete against us with it. We haven't seen that before. So we haven't seen this before. I don't know what will happen going forward. I've got time for some questions, I think, maybe, not much, but a few.
Didn't you have that kind of cash?
You know, India's growth cycle is pretty good. And so the answer to your question is probably. They can probably hurt us. They don't have to hurt us very much. I mean, 10 million metric tons really in the scheme of things, that's very small. In rice, it's a huge thing. But to India, the country, yeah, they could do it. Any other questions? Yes, sir.
Have definitions adjusted to the new way that we calculate the unemployment rate? The definition of recession, the other definitions and analysis?
You know, that's a good question, and I would tell you no, they haven't, because they don't want to change them. Because once you change them, then you change the history that you can go back and remember my technical statement. When this has happened in the past, this has happened. They don't want to change that scenario. So Not really. We haven't seen a whole lot of that. And of course, one of the big things has been the amount of labor that's available. You know, because everybody always talks about, well, the number of people that are available for work don't really show up in those numbers. But the market doesn't care about that. It's like when somebody comes to me and says, Dennis, do you believe the USDA report? You're dang right I believe the USDA report. Why? Because the market's going to believe it. Do I think that'll be the final number? Probably not. But I happen to believe it. Yeah, Milo.
This is an idle question, but have you looked at the demonetization in India and whether it had any impact on their agricultural system?
No, I have not. Have you?
A little bit. They're holding back cotton, and they aren't over it yet. I don't know what would happen in this country if you didn't have dollars circulating. I think people hold on to things. I don't know what that means.
Yeah, that's a good question. Milo and I live about 4 miles apart, and we have coffee and eat together every once in a while. So we get to bounce stuff off of each other. So that's a good one to look at. Sure
We
is.
have a meeting in Austin.
Yeah, I know. Question in the back? Someone else have a question? I thought I saw another hand. Yes, sir.
PLC payment, that was on the 100-weight?
Yes, yes.
Okay,
$4.20 is the USDA projection. It's $4.10 on the current average. We think it'll be closer to $3.80 when it's said and done, but I hope we're wrong. Maybe I hope I'm right. Hope we're right, because that would mean something's really good's going on.
When will the December and January information be added to the current projection?
About February the 15th, we'll start getting the next. We're about 45 days behind. Basically, what it is. Any other questions? Thank you, guys. The sign-up sheet's in the back if you need it.
Because I got a January 12th price. This is what I'll follow.
Where are my glasses?